Today, we are going to talk about one of the most powerful order flow tools available, Cumulative Delta. And I'm really going to give you the full, complete, unabridged guide that goes into way more detail about this than anything else that I've seen on YouTube. So get comfortable and save this video for a time when you have the time to really sit down and watch it, because this is going to be a long and detailed video. Not only will I show you some of the best ways to use Cumulative Delta, but I'm going to get into the nitty gritty of how this is actually calculated. And this will really help you understand what is going on, and it will also help you understand how my indicators for NinjaTrader 8 are a little bit different. There are some things that my Cumulative Delta can do that your standard Cumulative Delta doesn't. So I'm just going to do a screen share here. Now let's first get into what is Cumulative Delta. And the simple explanation is that Cumulative Delta is a running tally of all market buy orders minus all market sell orders. In other words, it tells you what the market orders are doing, and that can give you more insight into where that particular market is headed. In order to calculate this, we have to know whether an order is a market buy or a market sell, and typically this information is not given to you by the data provider unless you are paying extra for MBO data. So instead, we have to infer it by looking at the current best bid, best ask. So let me pull up the DOM here to show you an example. Right now, the best bid is at 110.28 in the 10-year treasury right here. And the best ask is at 28.5. So if a market order comes in and that market order is happening at 28.5 or above, that is at the best offer or above, we know that that was a market buy order. Similarly, if we get a sell order at, well, now it's 27.5. So if we get an order at 27.5 or below, then we know that it is a market sell order. And that is the basic classification algorithm that most Cumulative Delta indicators on future platforms rely upon. However, there are some edge cases that we have to worry about. You see, the data feed that gives you new volume is a different data feed from what gives you the current best bid, best ask. And these are not guaranteed to be completely in sync. And that can lead to a couple of interesting edge case scenarios. For instance, what if the current best bid and best ask are equal? In practice, this shouldn't happen because those orders should immediately match with each other. But what could happen is you just haven't received the update yet that the best offer moved up a tick. So this scenario isn't super common, especially not in futures. And so most of the time, these orders are just discarded by the indicators. And this is what my regular version of the Cumulative Delta indicator does. But another scenario you can get is when there is a large spread between the best bid and ask. So if you look down here at my micro treasury yield futures, the 2-year, you can see there is a really big spread between the best bid, best ask. So if I saw some volume in between those two, is it a market buy or is it a market sell? And what's often happening here is somebody is placing a limit order somewhere within the spread, and that order immediately gets picked off by an algorithm. And since this can happen so quickly, your system might just not see the limit order that was placed at the time it is looking to classify the market order. So in most futures, this isn't a problem because the spread is almost always just one tick. But in markets like these micro treasury yield futures or like Bitcoin, there can be a spread. And if you are doing stocks, then it really becomes a big problem because the majority of the volume happens inside of that spread. And this is probably part of why order flow tools like Cumulative Delta aren't included in most popular stock trading platforms. And this is why I have two versions of Cumulative Delta. My first Cumulative Delta is your regular Cumulative Delta indicator with some of the caching and those advanced features added in. The advanced Cumulative Delta is using some additional tricks to categorize that volume that happens in between the spread. So it is a very computationally intense because part of what it's doing is it's looking within a window around when an order was received to see if it can match it up with the market depth change to resolve that situation where the two feeds aren't completely in sync. It is very computationally complex though, so I wouldn't use it unless it's on an instrument where you really need it, like a stock or something with a wide spread. So with this indicator, it actually makes order flow analysis on stocks practical, and I must say it is a total game changer if you're willing to pay for the NASDAQ market depth data. Now, another thing to note about such order flow indicators is that to display historical values, you'll need to turn on tick replay. So to do this, first you need to bring over your NinjaTrader Control Center, go Tools, Options, and then on the left, you want to select the Market Data category. And then under Historical, you should see an option, Show Tick Replay, and make sure that that option is checked. If that option is checked, then when you come in here to the data series, there should be a tick replay option available. And with tick replay checked, this then allows the indicator to use historical best bid, best ask data to classify the volume. And on that, note that the values you get when calculating with tick replay will probably be slightly different than what you get when using live data. In fact, you're going to notice cumulative delta varies slightly between different data feeds and even just between different machines, because again, it depends on the order in which all of the events are received. In practice, the differences tend to be so small that most traders won't even notice, but this can be a problem for algorithms. It could be the difference between a threshold being triggered on a different bar, and that will completely change your backtest results. Not to mention that tick replay takes a bit to run, and while it's possible to backtest with tick replay on, it is a nightmare that I would just not recommend. And this is why my version of cumulative delta saves the result that it calculates to disk. That way you can backtest off the values you saw when the data was recorded live. And these files are saved in the saved folder under your Documents NinjaTrader 8 folder. You can see here. And the file name, depending on the settings that you set in the indicator, goes something like the instrument, the name of the indicator, and the date. So we can come in here and we can look at a past day. You can open it up in a text editor or inside of Excel. And here you can see all of the different values, the open, high, low, close for delta, and also this additional column that tells you whether this data was constructed from tick replay or whether it was recorded live. So now anytime that you load the historical data after that, it is pulling it from disk from this CSV file, and that means blazing fast backtests of order flow. And this was really the primary motivation behind building the entire NinjaTrader package, so that we could create algorithms and run backtests using order flow. Okay, so how do we use cumulative delta in our trading? The naive approach is to simply look at which way cumulative delta is moving and assume that price will continue to move in that direction. So here we saw a little bit of a move down, and you say, oh, so does that mean that it's going to turn around? But no, that is not what happened. A reality is that the correlation between price and cumulative delta is very complicated. So we need to dig a little deeper than that and talk about the actual market inefficiency that we're actually trying to take advantage of here, the autocorrelation of order flow signs. Order flow signs meaning whether an individual order was a market buy or a market sell as described in the classification algorithms earlier. So sign would be like positive for buy and negative for sell. So if you pick an order at random and then come back to pick another random order an hour later, there is a 0.5% higher chance that the two orders will be of the same sign, both buy or both sell. You'd think if it's just random that it would be a 50% chance that it would be a buy order an hour later, but it is actually a 50 0.5% chance. And this might seem really tiny, but it is actually a huge statistical difference. So why does this happen? Well, researchers have investigated many different possibilities, and the current evidence from their models suggests that it is caused by large meta orders. So when a large institution wants to buy or sell an asset, it is usually the case that their liquidity needs overwhelm the existing liquidity in the market. In other words, they can't just buy or sell it all at once without severely disrupting the market. So instead, they split the order up and execute it over time. This large order that gets split up is called a meta order, and such orders can take a long time to execute, and that's why we can see this autocorrelation effect even an hour later. So what I'm really looking for in my trading is signs that a large meta order of that nature is currently at work in the market. And one of the best signs of this is a slow and steady trend in the cumulative delta. So the closer that things are to a straight diagonal line, the more interested I am. That's the sign that a meta order is really at work that could still be at work an hour later. And by the way, if you want to represent this degree of autocorrelation quantitatively, try applying NinjaTrader's R-squared indicator on top of cumulative delta. The closer that is to 1, the more autocorrelated cumulative delta is. So you can see in my example here was a period where the cumulative delta was extremely autocorrelated, just continued to move up. And you can even see here there was a period where price kind of didn't really want to go long, but eventually they were dragged up by the orders. Now, another thing is I want to see decent correlation between cumulative delta and price. They aren't always perfectly correlated. For instance, you might see price move with delta staying flat, and this could happen if market makers are just adjusting their prices based on a correlated asset. Like for example, you'll see this in the 10-year treasury. The treasuries will move because the Japanese yen is moving, even though there isn't very many market orders coming into the 10-year treasury futures itself. Or maybe there is a strong change in cumulative delta, but price doesn't really move because liquidity providers are just eating it all up, preventing price from moving. Another thing that we should note here is that some instruments just behave differently with respect to cumulative delta. So for instance, all of the currency futures. So currency futures are really dominated. The thing that determines price the most is what's happening in the actual cash currency market that's going on with transactions between banks themselves. And most of what you're seeing in the futures is just hedging action. And so it is pretty common to see cumulative delta be the exact opposite of price over there. So here in the Japanese yen, you can see price is moving up, but cumulative delta is moving the exact opposite way. Now, when it comes to stock, I have found that stock prices really like to follow the index. And so in that case, cumulative delta might be a little bit more independent from price in a big stock move, but that's where it's useful because that cumulative delta might be a better indication of how people really feel about that individual stock rather than the price, which is mostly being dominated by the index correlation. Now, a common mistake I see with cumulative delta is focusing on when price and cumulative delta diverge, especially in the S&P 500. It's very common to see this sort of a thing where they diverge like this. And a lot of people will become really fixated on that must mean that there is a situation that we can trade. The problem is that there is really no guarantee that these two will come back in line. And even if they do, you can't really be sure which one it's going to do. Is price going to come back, or is cumulative delta going to catch up to price and push things further? And so it doesn't really result in a very good trade. It's really a 50-50 from the testing and so forth that I have done. And often as the case that when you get this situation, that price just kind of starts to meander sideways and you really didn't have a trade. So again, we want to be involved when we can front run a large meta order. So when price and cumulative delta are not very correlated, And when we aren't seeing that autocorrelation in cumulative delta itself, then we aren't in that kind of market where we are being driven by a large meta order. That means that we're in a random market that is more dominated by market makers, and that is a much more difficult market for retail traders to build an advantage in. Going back to this move, this is really almost a perfect example of where you would want to use it, because you can see cumulative delta is rising before this big move, and it's rising through this sideways move. And then, sure enough, we have another leg there. So this is a situation where that autocorrelation really comes through and is useful. Here is a situation where I'm not sure if cumulative delta is really as useful here, because, well, okay, they were correlated on this first big move up, but then cumulative delta starts to be pretty choppy. You can see here's a situation where we saw a big rise and then drop in cumulative delta that seems to be the opposite of what happened here in price. And so you're not necessarily getting that strong correlation between price and cumulative delta and that strong autocorrelation in cumulative delta itself. And so you get a market that, again, kind of meanders a little bit sideways. Now, another really effective use case for cumulative delta is for targets. It can be hard to predict how far a market will move in a given day because liquidity conditions vary. However, I have found that moves in cumulative delta can be incredibly consistent. The average move in the 10-year treasury is about 10K net contracts, with bigger moves being more in the 30 to 60K range. Here on this day, we kind of had some news that pushed us down, and then afterwards, a large meta order started to come in and eventually push us up. And you can see here the very low end of the move was about negative 5,000 contracts in cumulative delta, and the high is about 20, 25, 28. So we had over 30,000 contracts net change in cumulative delta. And I can come in and I can say, depending on how big of a move it is that I'm expecting, well, if this is a pretty big one, then, 30K could be a really good target. I can get out, and then, after it reaches 30K, it just, kind of starts to go sideways. So the way that I approach this is, first, if I have information that suggests that there should be a big meta order in the market that day, say for instance, it's end of month rebalancing, I can estimate how far I think the market will move in terms of cumulative delta instead of in terms of price. And I will use that cumulative delta difference as my target. We're estimating the size of the meta order and waiting until enough has traded to suggest that the meta order is probably done. And so now you know everything that you need to know about cumulative delta. And of course, if you have questions, please ask them in the comments. You can go and try my NinjaTrader package at speculatorset.com. You get a free 2-week trial with the download so you can try it, see how it works, see if it's useful for you before you buy. I will see you guys when I'm streaming every morning at 8:30 Eastern Time. In the meantime, stay excellent, team.